I'm Josh Young with Bison Interests, and we're going to discuss Unbridling Journey's full potential. Importantly, none of this is an offer, recommendation, or solicitation. Please review this disclaimer and keep this in mind. Past performance may not be indicative. So, just a little bit about Bison. We invest in publicly traded oil and gas companies. We launched in May of 2015, and Bison Energy Opportunity Fund has materially outperformed versus various energy benchmarks over the course of that 10 years, particularly versus the small cap energy index, which has an ETF PSCE, which is down about 59% since we launched, and Bison Net is up about 68%. We've owned Journey shares in size since about 2017. At a time, we were the largest shareholder of Journey, and we've successfully turned around another publicly traded oil and gas company in Canada. Our view on Journey has changed, despite having published previously positive analysis and perspectives on Journey's board, management team, and asset potential. We were ahead of the curve in terms of Journey's inflection in adjusted funds flow per share and other metrics that we saw from 2020 to 2022. However, these operating metrics have subsequently degraded materially, which has changed our view, and we find the explanations for these changes by the company to be inadequate at best. We're going to go through our observations on Journey's underperformance, reasons that we've identified for Journey's underperformance, and our call to action. Journey has underperformed materially over the past few years. Despite this material underperformance, Journey's management compensation and director fees are up substantially through Q2 of this year. We're still involved, partly because we were so vocal publicly about the stock, and partly because there is enormous value potential embedded in Journey's assets, from its proved reserve value and production value, to upside from local realized natural gas pricing, to potential value in the Duvernay, to potential value and real current value in the power generation projects that are underway. There are 4 drivers we've identified for Journey's underperformance. They include deteriorating operating metrics, project delays and cost overruns, high interest dilutive financing, and misaligned incentives and governance. We're going to go through those one by one. First, deteriorating operating metrics. Journey has underperformed materially from an operating perspective versus its own guidance that the company has formally issued over its roughly decade as a public company. Particularly, Journey has underperformed its guidance every year for the last 3 years. When considering the compounded effect of missing production guidance repeatedly and the reduced cash flows from those misses, along with the reduced reinvestment because of the reduced cash flow, there's potentially a lot more that's been missed than we just show from this straight, pure calculation of the precise number of barrels that are missing versus Journey's guidance annually. We find the explanation for these misses to be inadequate at best. In evaluating Journey's quarterly reports, we observed that Journey cites natural declines in 21 different quarterly reports through Q2 of 2024, while at the same time in Journey's investor presentations, it cites low decline, predictable production. On a per share basis, this looks even worse, where Journey's production per share has fallen by 27% since 2015, showing a material degradation despite significant executive compensation and high G&A. This cost blowout and production decline is incongruous with how Journey's competitors have fared. Using Journey's own peer set from its financial statements and from its corporate presentation, we note that Journey's operating cost per barrel skyrocketed from around $13 a barrel to over $20 per barrel of oil equivalent, while its peers saw a much more moderate increase and then actually a decrease over the last couple of years. And this may actually be understating the case, as subsequent to Q2, this differential in operating costs has continued to widen. This raises real questions about where all of this G&A is going and why there's been this substantial difference in operating costs versus Journey's peers. This presentation was made to Journey's chairman and to much of its board, and the theory provided by Journey's chairman, most of which will keep confidential from that conversation, but the theory provided by Journey's chairman, which I'll say was disconcerting, was that Journey's acquisition in 2022 led to its operating cost blowout. On closer evaluation, ahead of presenting to Journey's board, we looked at this acquisition that was cited, which one is too small to have been able to contribute to this full blowout in operating costs versus peers. As well, it's composed of at least one of the assets entirely heavy oil, which saw a much smaller increase in operating costs than Journey's overall production. And then the other main asset, there are real questions in terms of either the diligence being flawed by Journey ahead of that acquisition or the guidance being flawed around that acquisition, as material production and cost underperformance has been incurred on that portion of that acquisition over the last few years versus Journey's guidance at the time of the acquisition. We'll now address Journey's project delays and cost overruns. Journey is in the process of building and bringing on two roughly 15 to 16 megawatt power plants in Alberta, and Journey has experienced significant project delays and cost overruns on those projects. This seems odd to us, considering that in one case, a power plant was purchased that had been previously running with the representation of minimal capital required to bring it back online, and the other where the material equipment purchases were represented to have been made some time ago. So where are these project cost overruns coming from, and why are there these delays? I think these are reasonable open questions that do not seem to be well addressed in Journey's financial statements and other public statements. On the topic of the public statements, we noted an incongruity in public statements by the company's CEO and representations made by the company to its regulator, or one of its regulators. And I think this raises more questions than answers in terms of what's actually going on with these projects, why are they taking so long, and why are they costing so much more than the company guided. Similarly, there was a filing or a representation, by one of the regulators about the project status on one of Journey's power plants, delaying its online date from December 2024 to June 2026 on November 1st. Later in the month of November, Journey published a presentation and financials that said that at this time, Journey had not been provided with an initial start date for this power plant by this regulator. And then in the presentation, there was a date attributed to the power plant that was a year before what the regulator had just said in their public disclosure on November 1st. Similarly, with Journey's Duvernay new project, at one point Journey held 140 sections of land going into a joint venture with a prior joint venture than Journey's current joint venture in the Duvernay. And now Journey holds just 34 sections of land. Based on recent land transactions, just the value of losing those leases was over $100 million from failure to hold those leases and failure to secure development in line with that plan. Similarly, there were a number of wells that were supposed to have been drilled, and there were only a few of those wells drilled without comprehensive communication around that activity at that time. Now we'll discuss Journey's high interest dilutive financing. So Journey's interest rate has skyrocketed over its history or tenure as a public company, with interest costs up almost 200% from 2015 to 2024. This is out of line with comps, and Journey's recent dilutive convertible debt cost well above some of the interest rates of some of Journey's peers that are smaller or lower margin or more speculative or more highly levered. Journey unfortunately has a history of dilutive debt offerings where Journey issued debt predominantly to one lender, which came with a number of warrants which have led to substantial dilution of the stock over time. And recently, Journey issued convertible debt at a very high cost that was materially dilutive. This is very different from Journey's peers. Again, these are peers that Journey identified in its corporate presentation and in its financials. And those peers have been returning capital to their shareholders over the last 3 years, while Journey has incurred substantial dilution in that time. And again, in that time, while Journey shareholders have incurred substantial dilution, management and board have collected incentive compensation and various other payments. Repeat dilution reduces value of a company. Journey's production per fully diluted shares and reserves per fully diluted shares are down over the last number of years. And this doesn't even include the dilutive potential effect of the recent convertible debt deal that Journey entered into. Now we'll discuss compensation and governance. Journey's management salaries and director fees were up 164% as of Q2 versus production down 9% and Journey's stock in that time frame down 44%. Journey's G&A per BOE was up 40% over that time frame in Q2 2024 versus its peers on a BOE basis. So again, apples to apples. In addition, we noticed that in Journey's investor materials, it discusses the company's governance philosophy, and this is in the context of ESG. So there's an E slide discussing environment, there's an S slide discussing the social aspect of Journey's business, and then there's a governance slide. The governance slide seems odd at best to us because it focuses on the environment with numerous mentions of climate and no real discussion of fiduciary duty or shareholder value maximization. So Bison's call to action. We see potential for Journey to cut its operating expenses significantly in line with comps, to cut G&A in line with comps, to expeditiously bring its power projects online and to seek alternatives for power projects that are potentially being held up by regulators to the extent that that is a regulator problem and not a Journey problem. And then through cost cutting and delivering on guidance and unlocking some of the asset potential and cash flow potential embedded in the assets, we see room on Journey acting on the announced NCIB that was announced at a time where there was limited liquidity for the stock and limited ability for the company to actually act on it. But we see there is the potential with cost reductions and operating improvements for the company to act on its buyback, and through that, plus through deleveraging, to improve its production and other metrics per share. This is our contact info if you'd like to chat with us. Again, none of this is a recommendation or solicitation. This is not any sort of anything other than just our perspective on Journey. We have repeatedly shared our views on Journey publicly in a similar format over time, and we thought this was timely considering the upside potential that we see from improved operations and reduced costs and better aligned incentives for management and board versus very poor performance that unfortunately has actually degraded. We chose to show the exact presentation that we showed to Journey's board and have more to come, unfortunately, from further degradation in the business subsequent to this presentation and subsequent to Journey's Q2 results. Thank you.